Welcome back to the Deep Dive. Today, we are looking at, well, it's a puzzle. And it's a multi-trillion-dollar puzzle at that. We are digging into Invesco, one of the absolute giants in the asset management world. And if you just, glanced at the headlines for their Q4 2025 earnings report, which just dropped, you might think you were looking at two completely different companies.
It really is a tale of two spreadsheets. I mean, depending on which line you focus on. Invesco is either conquering the world or in deep trouble.
That is exactly what stood out to me. On one hand, as of today, January 27, 2026, they are, popping the champagne. They've hit a record $2.2 trillion in assets under management.
Trillion with a T.
With a T, it's a staggering amount of money to be responsible for.
It's a historic high for the firm.
Yeah.
By that metric, yeah, they've never been bigger.
But then you slide your finger down the earnings report to the bottom line, and the music just stops. You see a diluted earnings per share loss of $2.61.
Oh, no.
GAAP loss.
Yeah.
So you have record-breaking assets, but you're reporting a significant loss per share.
It causes a bit of cognitive dissonance, doesn't it? How can you be managing more money than ever before, but technically losing money for the quarter?
Exactly. And that is our mission today. We are going to unpack that contradiction. We're digging into the Q4 2025 report, the slide deck, and, of course, the call with CEO Andrew Schwarzberg to figure out how those two numbers can coexist.
Yeah.
Because the story here isn't just about a bad quarter or good quarter. It looks like Invesco is fundamentally re-engineering the machine while it's still running.
That is the perfect way to frame it. Schlossberg called 2025 a year of milestones, but when you look under the hood, those milestones were really about heavy lifting. They're moving what they call big rocks. These are structural changes to the company's foundation to survive in a market that is, frankly, hostile to the old way of doing business.
Moving big rocks sounds exhausting. But let's start with the biggest one they moved, which seems to be the balance sheet itself. Before we even get to the fancy ETFs and global deals, they spent a lot of 2025 just cleaning up their own checkbook.
They did. And for you listening, if you don't follow corporate finance that closely, this is crucial. Invesco had a capital structure that was becoming, let's call it, inefficient. A huge chunk of their capital was tied up in preferred stock, largely held by MassMutual.
Okay, let's pause there. Preferred stock. We hear this term, but
Yeah.
what does it mean in this context? Why is having MassMutual hold a bunch of preferred stock a problem for Invesco?
Well, think of preferred stock as a hybrid. It's kind of between owning a piece of the company and having a loan. And like a loan, it usually pays a fixed dividend. It's a guaranteed payout. For Invesco, that payout was becoming expensive capital. It's like having a credit card with a really high annual fee that you just keep in your wallet because you haven't gotten around to canceling it yet.
So even if Invesco has a bad year or a good year, they still have to cut that check to MassMutual first.
Essentially, yes.
Okay.
Preferred shareholders get paid before the common shareholders. That's you and me if we buy the stock on the exchange. So Invesco decided to get aggressive. In 2025, they repurchased $1.5 billion of that preferred stock.
$1.5 billion. That is a massive check to write.
It is. They did $500 million of that in December alone. But here's the payoff. By spending that cash now, they save approximately $88.5 million in dividend payments every single year moving forward.
Okay, so that's the ROI. They spend the cash now to stop the bleeding later.
Exactly. It cleans up the leverage ratio, brings it down to about 2.2 times, which keeps the credit rating agencies happy. But more importantly, it means that $88 million, it stays in the house. Eventually, that cash flow is available for the common shareholder rather than being earmarked for MassMutual.
It really feels like they're clearing the decks.
Yeah.
And they also paid off a term loan and some senior notes that just matured this month, right?
Yes, another, $740 million in debt cleared in total between the loan and the notes. So step one of this whole re-engineering was simply get leaner, stop paying interest and dividends on these legacy deals. It's financial housekeeping on a massive scale.
Which brings us to step two. And this one's fascinating because it involves a ticker symbol that I think almost everyone listening has heard of.
Yeah.
The QQQ.
The Qs, it's the gold standard for growth investing.
The NASDAQ 100 tracker. It's arguably one of the most famous investment products on earth. Invesco runs it. But on December 20, 2025, they changed what it is.
This was a huge technical maneuver that flew under the radar for most retail investors, but for Invesco's books, it was seismic. For decades, the QQQ was structured as A unit investment trust, or UIT.
A UIT, that sounds like something from the 1980s.
It pretty much is. A UIT is an older, clunkier structure compared to a modern ETF. It has expiration dates, rigid rules about dividends, and crucially for Invesco, the accounting rules for a UIT are different.
Different how? Did it change how much money they make?
It changed how they report the assets. Under the old structure, Invesco couldn't count the assets in the QQQ toward their long-term flows in the same way. It sort of sat in a different bucket, almost like a separate category of business. By converting the QQQ into a standard open-end ETF on December 20th, they essentially modernized the engine.
So overnight, just by filing some paperwork, what happened to their numbers?
Boom. They added over $400 billion to their reported long-term assets under management.
Wait, the money was always there, though.
Yeah.
They just moved it from the left pocket to the right pocket?
In terms of the total assets they oversee, yes. But in terms of the quality of those assets for the business, it's a huge upgrade. It's not just a vanity metric for the charts. It stabilizes the revenue. They're now earning revenue on that $400 billion in a way that is more consistent with their other products.
I noticed in the report they mentioned their exit net revenue yield, which is a fancy way of saying how much they squeeze out of every dollar. It actually ticked up to 22.7 basis points at the end of the quarter. Was that because of this?
That was a big driver, yes. When you modernize the structure, you capture fees more efficiently, and you align the product with how modern investors actually use funds. It turns a legacy trophy asset into a modern growth engine. It's no longer just this old thing sitting on the shelf. It's fully integrated into their ETF ecosystem.
It seems like a no-brainer. Why didn't they do this 5 years ago?
Complex regulatory hurdles. Converting a UIT to an ETF isn't something you just decide on a Tuesday. It takes massive legal and operational coordination. You have to get shareholder approvals, regulatory sign-offs. The fact that they pulled it off in 2025 shows how serious they are about this transformation. They basically rebuilt the engine of a race car while it was driving 200 miles an hour.
So they fixed the debt, they modernized their flagship product, but then we get to what I'm calling the global shuffle. Because while they're growing assets in the QQQ, they seem to be shrinking their footprint everywhere else.
Yeah.
Selling off pieces of the business in Canada and India.
This is the shrink-to-grow strategy. And honestly, it's becoming the standard playbook for asset managers who realize they just can't dominate every single market.
Let's look at Canada first. They struck a deal with CI Global Asset Management. What actually changed hands there?
Invesco basically handed over the keys to the office. CI acquired Invesco's Canadian mutual fund and ETF business. That's about $19 billion in assets. So CI now handles the back office, the distribution, the sales teams, all the compliance headaches.
But Invesco didn't just leave the country. They didn't just sell it and walk away.
No, and that's the nuance here. They stayed on as a sub-advisor for about $10 billion of that portfolio.
Sub-advisor. That sounds like a demotion.
It sounds like one, but financially it's often the sweet spot. As a sub-advisor, Invesco still picks the stocks, they manage the strategy, they do the high-value intellectual work. But CI has to deal with the operational drag printing, the prospectuses, answering the phones, dealing with Canadian regulators.
So Invesco keeps a slice of the fee for being the brains, but dumps the cost of being the body.
Exactly. They turn a high fixed cost business into a pure revenue stream with very low overhead. And they did the exact same thing in India. Sold a majority interest in their Indian asset management business to the Hinduja Group, but kept a 40% minority stake.
So if India's market booms, they still cash in on 40% of that growth, but they don't have to run the company day to day.
Right. It's about being an engine, not the whole car. They're realizing they don't need to own the entire pipeline to make money. They're identifying where their actual edge is, investment management, and outsourcing the rest.
They aren't just retreating, are they? Because at the same time they're backing out of operations in Canada and India, they are aggressively pushing into a new area in the U.S. private markets.
This is the barbell strategy. On one side, you have massive passive ETFs like the QQQ, low fee, high volume. On the other side, you want high fee, specialized products, that is private markets, private credit, real estate.
But building a private credit arm from scratch takes a decade. You need the relationships, the underwriting teams,
which they don't have time for. So they partnered up. They signed a deal with Barings for credit and LGT Capital for private wealth. And they're trying to shove these private market products into the U.S. wealth channel, so think financial advisors, and into 401k plans.
And MassMutual pops up here again, don't they? It feels like they are everywhere in this report.
They do. As part of the Barings deal, MassMutual committed $650 million in capital to seed these strategies. It effectively jumpstarts the product. I mean, you can't sell a fund with $0 in it. MassMutual provided the starter dough.
So if I'm understanding the strategy, Invesco is admitting they can't build everything themselves. So they're partnering with specialists, Barings for credit, LGT for wealth, and using Invesco's massive distribution network to sell those products.
Correct. They are becoming a platform. They plug in the best products, whether they own them or partner for them, and push them through their pipeline.
Okay, so I'm seeing the picture. Clean up the debt, modernize the ETFs, outsource the Methy operations abroad, partner up for the high-yield private stuff. It sounds like a brilliant plan.
It's a logical plan. It aligns with where the money is going.
But we still have to talk about the ugly number, the GAAP loss. You can have the best strategy in the world, but if you lose $2.61 per share, shareholders get nervous. What actually happened?
To understand the loss, you have to understand the flows, the money moving in and out. Invesco had strong net long-term inflows. $81 billion for the year. That sounds great on paper.
It does. $81 billion coming in.
But where did it go? It went to ETFs and index strategies, and it went to the China joint venture.
Low fees.
Very low fees. And where did the money leave? Fundamental equities. The traditional stock-picking business saw $5.5 billion walk out the door in Q4 alone.
And that exodus is what caused the loss.
Indirectly, yes. The loss itself, that 261 figure, was caused by a massive $1.8 billion impairment charge related to intangible assets.
We need to translate impairment charge for everyone listening. It sounds like your car broke down.
Think of it like this. Imagine 10 years ago, you bought a rare baseball card collection for $1 million. You listed that collection on your personal balance sheet as an asset worth $1 million. You convinced yourself that value was solid.
Okay, I'm holding on to my Mickey Mantle rookie card.
But today, you look at the market and you realize nobody really cares about baseball cards anymore. They only want Pokemon cards. That collection you bought is really only worth, say, $200,000 now.
Ouch. So the value just evaporated.
The market shifted. So you have to admit that reality. You take an impairment charge of $800,000. You didn't lose that cash today. You spent the money 10 years ago. But today, you're admitting that the asset isn't worth what you said it was.
So Invesco is admitting that the contracts they hold to manage these old-school active mutual funds are simply not as valuable as they used to be, because everyone is moving to ETFs.
Precisely. It's an accounting cleanup. It is a confession that the active management era of the past is worth less in the present. Specifically, these were management contracts related to U.S. retail mutual funds. It looks terrible on the GAAP earnings, but it's a non-cash charge. It doesn't affect their ability to pay the light bill or buy back stock.
That explains why, if you look at adjusted EPS, which ignores these one-time write-downs, they actually made 62 cents a share.
Right. And that beat the analyst expectations of 57 cents. So operationally, the business is profitable, the lights are on, the cash is flowing, but the accounting requires them to be honest about the declining value of their legacy business.
That honesty seems to be a theme here. Which brings us to the future. We've talked about the cleanup, but let's talk about the net revenue yield. They cited 22.5 basis points.
This is the most critical metric in the industry. A basis point is 0.01%. So for every $100 Invesco manages, they earn about 22.5 cents.
And that number is dropping.
It's compressing. It's the volume game. Because money is flowing out of expensive funds where they might earn 60 or 70 cents and into cheap ETFs where they might earn 5 or 10 cents. So the average keeps dropping.
So they have to manage more and more money just to make the same amount of revenue. It's like running on a treadmill that keeps speeding up.
That is exactly the dynamic. CFO Allison Dukes pointed out that the compression is slowing down. It's not dropping as fast as it used to, but the trend is still down. She mentioned that the mix shift towards lower fee products is just a reality of the modern landscape.
So how do you win on a treadmill?
You get extremely fit, you cut costs. Invesco is building something they're calling the hybrid investment platform.
Which sounds like buzzword soup. What is it?
It's their tech stack. Right now, running a global asset manager involves a messy web of different systems, some for trading, some for risk, some for reporting. They're spending money now, about 25 to 30 million extra in 2026 to unify all that.
Taking the medicine now to feel better later?
Yes. The guidance is that these costs will drop off in 2027. They are spending to automate. If you can't charge more for your product because of fee compression, you have to spend less to manufacture it. That means technology.
Despite all this, the impairment, the spending on tech management seems pretty confident about capital return. They're buying back their own stock.
They are. They plan to buy back $40 million of common stock in Q1 2026 alone, and they're targeting a total payout ratio, that's dividends plus buybacks, of near 60% for the full year.
60% of their earnings going back to shareholders. That is a very friendly number.
It's aggressive. It signals that they believe the worst is over, they believe the big rocks have been moved, the balance sheet is clean, and they can generate enough cash to reward the people sticking with them. It's their way of saying, we survived the renovation, now look at the house.
So let's step back and look at the whole picture. We started with this mystery. Record assets, but a massive loss.
And the answer is that 2025 was a renovation year. They tore down the old walls, getting rid of the debt and the preferred stock. They threw out the old furniture, taking the impairment charge on active funds. And they installed a new modern kitchen, converting the QQQ and partnering for private markets.
It is a story of adaptation. Invesco isn't trying to fight the tide of passive investing. They aren't standing there yelling at the ocean.
No, they are building a boat that floats on that ocean. They're pivoting the entire organization to align with where the world is actually going, which is low-cost beta through ETFs and high-value private alternatives through partnerships.
It's impressive, but it leaves me with a lingering question. We see this impairment charge, $1.8 billion written off because active management contracts aren't worth what they used to be. We see the money flooding into the QQQ.
It certainly paints a vivid picture of the industry's direction.
Is this the final nail in the coffin for the stock picker? If a giant like Invesco, which built its name on active management, is essentially writing down the value of that business and betting the farm on ETFs and partnerships, is there any room left for the traditional mutual fund manager?
It's the existential question of the decade. Or look at it from the other angle. Is Invesco's pivot to private markets that deal with Barings, is that the only lifeboat left? If you can't beat the computer in the public stock market, maybe the only way to generate alpha anymore is in the private deals where the computers can't go.
Go private or go passive. That seems to be the message Invesco is sending.
It certainly looks that way, and Invesco is positioning itself to be the bridge to both.
A fascinating turnaround in progress. We'll be watching closely to see if that 22.5 basis point yield holds up in 2026. That is it for this deep dive into Invesco's transformation. Thanks for listening, and we'll catch you on the next one.